Good morning, ladies and gentlemen. Welcome everybody to the first in our three-part series of Regulatory Insights webinars, this one titled The New Norm in the Equities Market. My name is Rick Irving, and I'll be co-hosting this webinar with Monique Martinez from Merchant Tech, as well as Nikita Hunter from Acorim. We'll also be joined by Keith Rayner from Car Presentations, who's our guest speaker today. So in terms of the agenda this morning, Keith's going to kick us off with a JSE Listings Requirements Refresher. This is a high-level presentation on the amendments to the JSE Listings Requirements in terms of Service Issue 27, focusing on what directors need to know. Monique and I will then take you through the impact of COVID-19 on financial reporting for listed entities. And Nikita is then going to close us out with a board checklist during the COVID-19 pandemic before we do a brief Q&A with the time that we have remaining. So if you do have any questions, please drop them in the Q&A section in the bottom of the screen as we go, and we'll address those at the end. Also, please specify who the question is addressed to. If we don't get to your question in the allocated time, we're happy to pop you an email and engage further. That's it for the introduction and the housekeeping. So without further ado, I'm going to hand over to Keith. Thanks, Keith.
Thank you, Rick. Good morning to everybody. I'm going to be covering the equity listings requirements. The debt listings requirements were covered previously. They won't be covered today. I'll make brief mention of them later. So I will be covering the amendments contained in issue 27 of the equity listings requirements. This slide details where we find the law. It's included in the current issue, any bulletins issued thereafter, any guidelines, and if you look at any current announcements, that will tell us what's coming later. The transition letter applicable to these requirements dealt with years ending on or after 28 February. Those are all now effective. And the 30 June effective sponsor independence provisions are still to come. And we have a number of year and 31 December requirements that will kick in only at year end and later, which deal with public shareholder disclosure, board diversity policies, audit committee consideration, assurance sign-off, and sponsor update of procedures manuals. Looking at section 4, main board listing criteria, we find an amendment whereby the JSE requires the requisite capital to already have been raised for any applicants wishing to list onto the main board, and would probably be applicable to AltX as well. Looking at a new definition of extended family, this applies to a director and the director's spouse of a listed company, and it includes parents, siblings, and major children of the director and the spouse concerned. The JSE has also introduced the prescribed officer definition, which includes all employee persons with executive power, and this executive power is either continual or periodic. We now move to public shareholder definition. So 425 of the requirements deals with persons who are not regarded as being public shareholders, and we find the introduction of extended family, prescribed officers, and any persons that have trading restrictions longer than 6 months on their listed securities. There is an exemption in terms of the disclosure and the calculation of public shareholders, and this applies to disclosure of public and non-public persons in audited annual financial statements, and that excludes extended family persons, effectively meaning there are two definitions of public shareholders. With respect to initial primary listings applications to list onto the main board of the JSE, we find a number of amendments requiring confirmation of public and non-public persons at date of listing in terms of the 20% compliance requirement. We have a material objection timetable introduced into initial applications for listing onto the main board, and this involves material objections received over an 8-day period having to be dealt with prior to listing date on D0. If they are not dealt with, the listing will be either terminated or postponed to a new date. Dealing in securities usually applies to directors of listco and major subcos, company secretaries and their associates. We now find prescribed officers included, so prescribed officers require approval to deal, and their associates, whilst they don't require approval to deal, do have notification requirements, which will end up being disclosed on SENS. We also have amendments to the dealings disclosure requirements, which affect pledges of shares by any person subject to the dealings requirements. This is required at the time of entering into the pledge, and thereafter, as and when the pledge arrangement is changed or terminated. And we find that also included in the annual disclosure and the audited annual financial statements, dealing with disclosure of any securities by listco directors that have been pledged. Sponsor independence, we leave to sponsors, and they are required to apply the old rules by 30 June this year. Moving on to short form press announcements. If a listed company announces in the press, in that very shortened format, any annual financial statement information, it must include disclosure of the key audit matters and the type of opinion that was issued by the audit firm, and this is done by way of a link to the website of Listco. Going through secondary listings very quickly, the JSE has amended their model. So if we have a foreign primary listed company wishing to apply for secondary listing onto the JSE, if they're applying to the main board, you can see a list here of 10 acceptable approved foreign exchanges, which would result in the JSE approving a secondary listing onto the main board. For Altex, there's a slight variation whereby the list of approved exchanges is applicable, but also any foreign exchange that's a member of the World Federation of Exchanges. There have been a few amendments to current existing requirements in Section 18. They deal with any foreign issuer being on an approved exchange, but that exchange is not in the country of incorporation, and the JSE will do a fit and proper test there. The JSE requires disclosure on a recognized accounting framework for interim and year-end results, and any disclosures of changes in beneficial ownership or dealings by directors in securities that are affected in any foreign market are required to be disclosed on the SENS on the JSE. We still have the requirements whereby any foreign issuer on a stock exchange that is not an approved exchange can obtain a listing as a secondary listing onto the JSE, provided the JSE performs a fit and proper test on that particular foreign stock exchange. It is still possible to move a primary listing from the JSE to a foreign stock exchange. It is quite onerous now in that the other exchange must be an approved exchange, and we require independent shareholder approval. Remembering that the SARB is the biggest problem with respect to this type of corporate action. The disclosure of financial results by way of a reference through a URL is working since last year, 2019, so I won't spend too much time on that. Altech's business plans have been updated in terms of a guidance letter in September 2019. That takes us to performance measures. Remembering performance measures are any disclosure on a per share basis that does not comply with IFRS. They are allowable, but you must apply the pro forma rules. That means a reporting accountant must sign off on any annual pro forma performance measures. At interim, it's not required. So we wait for these rules. They will be coming out sometime in the future. That takes me to COVID-19, which I will not cover in detail because it's been covered later in this presentation and was covered previously by Merchant Tech. So the only guidance letter I would like to make reference to that is not covered later is the possible or impossible cancellation of dividends that have been announced. Without going through all the detail of this slide and the following slide, the JSE announced that it is not possible to cancel a dividend and that compliance must be effected with the Companies Act. Actually, it is possible to cancel a dividend and it is detailed here, but it is quite a process. So please refer to the slides if that is of interest to you. Listed securities and other securities are required to make disclosures of any price-sensitive information on a continuing basis, which we have seen a large number of listed companies effect from time to time. The JSE has given some guidance with respect to corporate actions and exemptions. In short, they will assist any listed companies in financial difficulties by way of exemptions given with respect to raising cash to make themselves liquid and solvent. With respect to IFRS and auditing standards, the IRBA and SAICA have provided some guidance and some educational disclosures with respect to important accounting and auditing matters that should be considered during COVID-19. So everyone is recommended to go and look at those websites and have a look at all those important scenarios. Thank you. That concludes. I will now hand over to Monique.
Thanks, Keith. Can you just stop your share screen there?
Thanks, Keith, and good morning, everyone. My name is Monique Martinez from the Merchant Tech Capital team, and I'm looking forward to spending the next short while with you as Rick and myself unpack the 4 guidance letters issued by the JSE subsequent to the outbreak of the coronavirus pandemic, and which relate specifically to the impact of COVID-19 on the issuer's financial reporting obligations. The JSE's guidance letter dated the 10th of March is the first of the 3 subsequent letters, and in this letter the JSE noted that in certain instances, an issuer's ability to comply with the timely publication of its financial results in terms of Section 3 of the Listings Requirements may be impacted, and accordingly encouraged issuers to discuss any issues with their sponsors and to engage with the JSE accordingly. The letter gave an indication that, although undefined at that point in time, the JSE would provide some sort of exemption to issuers. In the second letter dated 25 March, which made reference to the letter of the 10th, the JSE advised issuers to assess the impact of the pandemic on their financial reporting obligations in respect of their interim, preliminary, and provisional results, annual financial statements, as well as the notices of AGM with regards to the timing of the publication, the completeness of content, and also the timing and nature of the auditor's reports on this information. In the instances where these are impacted, issuers may, via their sponsor, request a reporting variation ruling from the JSE, which the JSE will consider on a case-by-case basis. These reporting variations include an extension to the reporting period timeframe, a variation on the minimum content and disclosure of the financial information, and/or a variation on the timing and nature of the assurance report. Where the reporting variation ruling is approved, issuers are required to publish a SENS announcement detailing the nature of the reporting variation and the variation granted, the reasons for such reporting variation, as well as the expected timing of the normalization for the issuer's reporting obligations. Additionally, in the letter of 25 March, the JSE advised that in the case of issuers who are no longer able to publish results on a quarterly basis, they must apply the requirements of trading statements. Issuers must also consider the general obligations of disclosure with respect to price-sensitive information. The JSE noted that where reporting variations are utilized, trading statements serve as an important tool in providing investors with insight into the financial performance and financial position of an issuer, and so issuers must consider publishing a trading statement even when the differences are less than 20%, but are viewed to be sufficiently important. I'm now going to hand over to Rick.
Thanks, Monique. The JSE's third letter, dated 3 April, deals with the extension of financial reporting timeframes and makes reference to the letter of 25 March, in which issuers were advised that the JSE would consider granting a reporting variation on a case-by-case basis, as mentioned by Monique previously, as well as to an FSCA notice. Now, the FSCA notice confirmed that a blanket extension of 2 months had been granted to all equity and debt issuers with December 2019, as well as January, February, and March 2020 year ends. The extension applies to the publication of provisional results and annual financial statements, as well as the distribution of annual financial statements and the notice of annual general meeting. What this means is that for equity issuers, provisional results only have to be announced 5 months post year end, and annual financial statements only have to be issued 6 months post year end. It's important to note that the extension does not apply to interim results. Additionally, if issuers are to make use of the extension, they should ensure, firstly, that the market is updated through SENS, and secondly, that the JSE is notified in writing as soon as the issuer takes the decision to do so, and this must obviously be done before the existing deadline in terms of the listings requirements. The JSE's letter dated 24 April deals with various accounting and auditing matters with regards to COVID-19. They advised that a South African COVID-19 task force has been established to align the activities of all financial regulators, as well as the accounting and auditing profession as a whole. In respect of accounting matters, SACA has created a central repository dealing with the financial reporting matters. A portal is available on the first link in the slide, which we'll obviously share with you after the webinar, and it includes educational documents covering topics such as post-balance sheet events, going concern, estimates and judgments, etc. Obviously those items which are pertinent in the current COVID-19 reporting environment. In respect of auditing matters, IRBA has a similar portal which can be accessed via the second link on the slide, providing guidance to auditors in respect of COVID-19 matters, and these largely pertain to going concern. We suggest that issuers consider all accounting and auditing issues at an early point in a reporting timetable and engage with their auditors accordingly. That's all from me. I'm now going to hand over to Nikita.
Thank you, Rick. Good morning, ladies and gentlemen. My name is Nikita and I'm from Acorim. Acorim is the company's Secretarial and Corporate Governance Advisory Division of Merchantech. And today I'll be taking you through a presentation titled A Board Checklist During the COVID-19 Pandemic. The COVID-19 pandemic and its rapid global evolution has placed immense pressure on companies as they try to adapt to the situation and communicate their response. The impacts of COVID-19 on business, according to a Stats SA report released in April, shows that 85.4% of responding businesses had a turnover that was lower than their normal range. with 1.3% reporting that turnover was higher than their normal range and 13.3% reporting that turnover was within their normal range. It is crucial that boards and the executive collaborate to find the best way forward for the business. The executive management have the principal role in navigating the storm by taking steps to safeguard the staff and resources, while executing on a crisis response plan and addressing the day-to-day needs of the business. The board is responsible for overseeing this work done by the executives and monitoring its progress. In order to assist boards during this time, I will present a checklist of practical steps to be considered in responding to the current crisis. Firstly, health and safety should be a topic on the agenda of every board meeting. The health and safety of staff, customers, suppliers, and communities must be a priority for the company. Directors need to monitor management's efforts to support containment of COVID-19 and satisfy themselves that planning and executions of those plans is sufficient. Next, directors need to stay informed. Directors need to be vigilant in understanding the facts on the ground on the pandemic's evolving impact, both in the broader social, economic, and political environment, as well as in the context of business specifically. In order to respond effectively to changing circumstances, directors need to be equipped with all relevant information. Management can assist by providing regular updates and reports to the board on new developments, and directors should track reports on the effects of the pandemic and share this knowledge. Next, the board should hold regular update meetings. If a regular board meeting is not scheduled for the near future, the board should call a special meeting to discuss the impacts of COVID-19 and the company's response. Given the speed at which the crisis is evolving, the board will likely need to meet more often than before. Schedule bi-weekly update meetings to be conducted virtually to eliminate the need for travel. The closer financial distress is for the company, the more often the board should meet, if for no other purpose than to receive an update. The board's oversight during these meetings should be documented in board minutes and decision registers or resolutions by your company secretary. These business update meetings should be used to assess and reassess financial resources. Directors should understand, for example, the company's capital structure, cash sources and needs, upcoming debt service requirements, and loan covenants. Businesses face much higher operating expenses as they strive to maintain a safe environment for their employees and customers. As the situation continues, organizational survival will depend on the financial resources in order to support continuing operations and the company's ability to operate in a post-pandemic world. The rate of change during the current crisis has been faster than most expected, and conversely, the recovery may be much slower than hoped. Next, the board will need to review management's crisis response plans. Here, the company will need to take swift and deliberate action in response to changing circumstances and the need to protect the long-term viability of the company. The crisis response plan should highlight the responsibilities and contact details for key team members, both internally and externally, address responsibility for communications, including perhaps a media spokesperson and a leadership individual internally for employee communications. The plan also requires careful prior review of public statements, requires consideration of the potential impact on affected stakeholder groups, including contact information for communication with key stakeholders, as well as a business resumption plan to get things back on track as quickly and efficiently as possible. Next, the board should assess the risks. If this is done by your audit and risk committee, that's also fine. They just need to report back to the board on these assessments of risks. The board should review with management the principal risks to the organization and assess and monitor management's efforts to identify, prioritize, and manage them. During the pandemic, key risks areas include supply chain risks. Because we live in an interconnected world with fast transportation and even faster communications, resulting in supply chains that are normally geographically dispersed and long, the closing of borders and forced lockdowns of regions across the globe have tested these arrangements. The board needs to satisfy itself that the organization has mapped its key suppliers and underlying suppliers, and whether alternatives have been identified to continue to support operations. Next, technology risks. Obviously, social distancing and the need for isolation has accelerated the adoption of technology. The board needs to understand where critical data is held or if it's accessed through third-party service providers, and whether it is adequately protected against cyber breach. On the regulatory side, here regulators are gradually re-examining and adjusting their requirements. Other speakers have already touched on this, and the board will need to keep up to date with these changes. In terms of internal controls, here existing control systems were not designed for as rapid a transformation as businesses have been experiencing. Therefore, the board should review these controls and adapt where necessary. We've already touched on cash flow risks during those business update meetings. So lastly, I'll just touch on business continuity or contingency risk. Existing business continuity plans need to be periodically reassessed and adapted in the light of the speed at which change is occurring. Then the board needs to assess management's communication strategy. In the current crisis, maintaining honest, thoughtful, and clear communications can reinforce those attributes and provide the organization with the space it needs to deal with the evolving situation. In contrast, one of the fastest ways to lose trust is to overpromise and underdeliver by providing assurances on matters outside of the organization's control, or that the organization subsequently is unable to satisfy. The board needs to be comfortable that management has a plan for communicating in its response to COVID-19 pandemic in a fair, balanced, and timely manner. Lastly, the board needs to keep a long-term focus. The COVID-19 pandemic will eventually end, and the extreme measures currently being taken to mitigate its impact will cease. The move to technology, an increased focus on human health, reduced globalization, and stronger domestic supply chains are just some of the changes that are expected. The board needs to consider how to best position the company for success in the new world to come. Thanks so much. That's all from me. I hope you found the checklist useful. And now we will watch a short video just before we move on to Q&A.
Thank you, ladies and gentlemen. That concludes the presentations for this morning. We have received a couple of questions, and I think we have just a couple of minutes left, so we'll address some of them now. Remember that should you wish to have a one-on-one with the team, feel free to pop a comment to the panelists or an email at our sponsor team at merchantech.co.za email address, and we're happy to set up a call or a Zoom call with you guys. So the first question that we have is for Keith. If the panelists just want to turn on their cameras and come off mute. Okay, the question is, Keith, you mentioned that the definition of extended family has been amended. Does this relate specifically to the new disclosure requirements in the annual financial statements or annual report in respect of public shareholders, or is the new definition going to affect the requirements of dealings in security?
Thanks, Rick. So the extended family requirement has been written with respect to non-public shareholder identification, and that leads into disclosure and non-disclosure of public and non-public shareholders in audited AFS. But for purposes of that disclosure, you're able to ignore the extended family definition. Therefore, the extended family definition only applies to the definition of public and non-public persons with respect to corporate actions, being initial, primary listings, and also general issues of shares for cash. I'll hand back to you now.
Thanks, Keith. The second question is for Monique. Monique, will the JSE's letter dated 25 March 2020 relating to financial reporting variations also apply to companies with a year end in June? So, for example, will a company with a year end in June also be able, in consultation with their sponsors and with due consideration of the effects of the pandemic, be able to request a change in timing of annual results?
Thanks for that question. So at this stage, the blanket dispensation following the market notice issued by the FSCA applies to companies with year ends up to March 2020. However, per the JSE's letter of 25 March that was referred to, the JSE will assess reporting variations on a case-by-case basis, depending on the specific circumstances applicable. So to answer the question, the letter of 25 March is applicable, but in order to receive a dispensation on the timing of the year-end results, a motivation setting out the issue's specific circumstances would need to be submitted to the JSE for consideration to determine whether the JSE feels that such circumstances warrant a reporting variation.
Super. Thanks, Monique. We have another question for Keith. Keith, could you summarize the process to cancel dividends already declared but that have been postponed?
Yeah, thanks, Rick. And I responded, I'd do it live. So without going back to my slides, the JSE rules regarding corporate actions are that if a dividend has been declared, obviously the solvency and liquidity test would have been passed, and the company is proceeding now along a timeline and must follow through and pay the dividend. And the JSE has been at pains to say, therefore, you cannot announce that you are merely cancelling a dividend, but what they did do was then refer persons to compliance with the Companies Act. Now it starts getting fairly complex, because the Companies Act then goes on to say in the relevant section that if you have not paid your dividend within 120 days, then the board must effectively reconsider the solvency and liquidity test. And at that point in time, if the solvency and liquidity test was failed, then the company would not be able to proceed because of the failed solvency and liquidity test. So in that way, the original dividend would, in inverted commas, be cancelled. But it's quite a complex timeline to get there. If, therefore, the dividend is paid or is going to be paid within 120 days, then that does not apply. Back to you, Rick.
Thanks, Keith. And then I think just the last question that we have time for is one for Nikita. And the question is, should a specialist committee be constituted to deal with the crisis?
Thanks, Rick. It's not necessary. You can reevaluate whether existing committee structures are sufficient to provide effective oversight of the risks and make changes as necessary. So don't be afraid to add committees or restructure existing committees. You can also consider the board's current composition and consider if the board is appropriate to lead the company through the changing landscape. You can do this by evaluating the director's abilities to identify and address risks, and whether the directors have the skills to understand new risks which have arisen from the pandemic. Thank you,
Thanks,
Rick.
Nikita. Okay, that's all we have time for this morning. So thanks everybody for your attendance, and thank you so much, Keith, for joining us once again. We have enjoyed engaging with all of you guys out there. Look out for the follow-up email, which will include links to the recording of the webinar. So have a great day further, everybody, and bye for now.